Welcome to 5X series, company number 3, Celsius Holdings. Its stock went up 4,000% in the past 5 years, and that's a 40x gain. It's currently trading at about $53 with a market cap of about $12 billion. So in this video, I'm going to talk about whether this is a 5x opportunity from today's price or not. The stock appreciated significantly because of multiple reasons. Number one reason is their revenue growth rate. As you can see on the screen, on an average, they grew triple digits in the past 8 quarters. And they are already profitable. You can see that their profit margin is more than 25%, which is phenomenal for the kind of business that they are in. And look at the share dilution. They pretty much did not dilute the shareholders in the past 2.5 years. So these are the characteristics of a multi-bagger, and Celsius Holdings have all of them. And that's why the stock appreciated significantly. Moving on to Celsius business model, they are a functional energy drink company that sells beverages. These beverages apparently help people with weight loss and also get some energy. And they're also distinguishing themselves from their competitors like Red Bull and Monster by saying that they do not have any artificial or sugary flavors like high fructose corn syrup or any other artificial flavors. So they're saying that they are a healthier energy drink alternative, and apparently that's catching up because a lot of people are buying these drinks. When you're a beverage company, the biggest challenge is distribution, and Celsius cracked it. As you can see on the screen, they have strong customer base in convenience, grocery, fitness, e-commerce, mass market, vending, military, vitamin specialty, and drugs. So they have increasing penetration across major distribution channels to retail locations. In addition, they have a partnership with PepsiCo, where Pepsi can distribute their drinks worldwide. And why are Pepsi doing it? Because they bought close to 8% ownership in Celsius with about $550 million. But that comes with another caveat where they're going to get a 5% annual dividend paid quarterly. So this seems like a rich deal, but I understand why Celsius partnered with PepsiCo, even though this seems like a rich deal because they need that distribution worldwide and they cannot get it without Pepsi. Now let's look at a couple of facts before we move on to the numbers. As you can see on the screen, almost 95% of their revenue comes from North America. Europe, Asia, and other countries contribute next to nothing. So they have a huge opportunity outside of the United States. Another fact that you need to know is almost 65% of their revenue comes from Pepsi. And they're also part of Costco, and about 25% come from the other channels. Now let's move on to the financial numbers. At a stock price of $53, it has a market cap of about $12 billion. The PE ratio is about 112, which is expensive. In addition, when you look into their past 12-month revenue, it's about $1.25 billion, which puts us at about price to sales of 10, which is extremely expensive for the kind of company Celsius is. So make no mistake, this is an extremely expensive stock at this moment. Now let's look at the income statement of their most recent quarter to get an idea of their margins. As you can see on the screen, in the most recent quarter, they made about $384 million of revenue. And the gross profit is about $194 million. That's 50% gross profit, which is very impressive for the sector that they operate in. And when you look into the operational income, that's close to $100 million. So that's an impressive margin. And when you look into the net income, that's about $83 million. Let's look at stock-based compensation. As you can see on the screen, it's $16 million in the most recent quarter, where they made $400 million of revenue, right? So that's almost 5%, about 5% of their revenue, which is negligible. So I'm not too worried about the stock-based compensation. Let's look at their balance sheet. This company is already profitable, right? They have close to $760 million of cash and cash equivalents and almost no debt. So this is a very good position to be in. Now that we are done with the financials, let's move on to the valuation. Before I move on to the valuation, I want to clarify that this is not financial advice. I'm not qualified to give financial advice. I'm simply recording my thoughts. I'm going to show two valuations. The first valuation is the 5x case. So what does it take for Celsius to get to 5x by 2030? That is in 7 years. As you can see on the screen, in 2023, we do know they made about $1.25 billion of revenue, and they are pretty much growing triple digit now, right? And they also have a lot of room to grow outside of the US. I'm estimating an average growth rate of 30% for the next 7 years to put them at $7.8 billion of revenue in 2030. $7.8 billion of revenue by 2030 is huge, right? We need to double check whether this is even possible for the industry that they're in. And looks like it is, because Monster makes close to $7 billion of revenue already in 2023. So Celsius making $7.8 billion by 2030 doesn't seem unreasonable to me, because they are distinguishing themselves from their competitors. They also have strong partner network and a perfect distribution partner like Pepsi. So I don't think $7.8 billion is unreasonable by 2030. Their current net profit margin is wavering between 20% and 30%. Their competitors are actually making close to 25% net profit margin. So I can clearly assume 25% net profit margin for Celsius, because they can scale very quickly with their partners, and as they get bigger and bigger, they can control their operating expenses and get to this 25% net profit margin. So with that, they can make close to $2 billion of net income in 2030. For a company that's growing at 30% and have a 25% margin, I can pay a premium multiple of 35, maybe more, but 35 I think is reasonable. With that, the 2030 market cap will be about $69 billion. Currently, they have close to 222 million outstanding shares. They barely dilute the shareholders, right? Because their stock-based compensation is negligible when compared to their revenue, and they have a lot of cash in their balance sheet. They're already profitable. So I don't see any reason for Celsius to dilute shareholders. Yet, I assume 2% dilution, with which they will have 255 million outstanding shares in 2030. When I divide the $69 billion of market cap with 255 million outstanding shares, I get a stock price of $269 in 2030. Currently, they're at $52, right? So that's about 418% or a 5x in 7 years. And in my opinion, all these metrics do seem reasonable. They do not seem like an impossible task for Celsius. Of course, there are some risks. Another competitor can come up with a healthier drink than Celsius that can eat into Celsius growth and also margins. So that risk is there. And also they're a beverage company, right? So they do not have so many diversified products to survive. So if there is competition that's catching up, they can get into trouble. But at the moment, I'm not too worried about that, because they already are making more than $1 billion of revenue. So that's not a joke. It's very, very impressive that they're making that kind of revenue just with energy drinks. And also they have very good partner network, and their marketing is great. And they're also in Costco. We know Costco is very, very selective about the products that they choose to put in their store, and Celsius made the cut, right? So I think 400% or a 5x in 7 years is possible for this company, but I'm cautious. So you can ask me what I am doing. And if you follow me long enough, you know that I only look at the next 5 years out valuation, and I invest when I see a 2x for companies like Celsius. So let me show you that valuation I care about. In 2023, we know they made about $1.25 billion of revenue. I'm estimating 30% growth for the next 5 years, which will put them at $4.6 billion of revenue in 2028. I'm assuming a 20% net profit margin. Currently, they are way ahead of that, but I'm assuming 20% because I think competition is going to catch up. So with that, they'll make close to $1 billion of net income in 2028. I can pay a multiple of 30 for this kind of growth and profit margin. With that, there will be $28 billion of market cap in 2028. I'm going to keep the same dilution, 2% dilution for the next 5 years, year over year. With that, they will have 245 million outstanding shares in 2028. When I divide the 28 billion market cap with 245 million outstanding shares, I get a stock price of $114. Currently, they are close to $52, right? So that's about 118%, which gives me a 2x comfortably. So I'm going to only put $1,000 at this point and buy close to 20 shares. The main reason is this stock is extremely expensive and it has been volatile. Like there are days when this stock fell 40% or 50% in one day. And currently they are growing close to triple digits. And even if they show you a 50% growth rate, that's going to be seen as an underperformance and the stock is going to fall significantly. So that's why I'm going to get my feet wet with this stock with $1,000, and I'll continue to add whenever the stock drops significantly and the fundamentals do not change with respect to the margins. So that's my plan. Let me know your thoughts in the comments. Thank you so much for watching.